My question is the revenue of 400 billion and a deficit of 150 billion sufficient to support an ecosystem of OTT derivatives in the order of 7,29,000 billion? What are these derivatives composed about? I have been analyzing the global macroeconomic landscape for quite a while now. Last 20 years, I am following these trends across the US and the global equity markets and so on and so forth. So these are some quite interesting numbers that I came across. So when I look deep into the US revenue, the revenue side is somewhere like around 400 billion per month. The expense side is somewhere around 550 billion per month. The deficit, the gap between the income and the expense is somewhere around $150 billion per month. So yeah, these are numbers that I looked into deeper to understand what is really going on in the global economy for fun. So I've been doing that for quite some time now. So these are very interesting numbers, like the deficit is somewhere around 150 compared to the revenue of 400 billion around monthly. Now if you look into the accumulated debt, so the US keeps on issuing treasuries, the bonds, they have to pay interest for these bonds. That is how the debt is generated into the system. So this deficit gets translated into debt. Okay, the debt comes around 38,000 billion total accumulated debt. Now if you look into the pension and Medicare obligation that US government has to pay, so it comes around say 72,000 billion in total. Now, as per Bank of International Settlement, if you look into the total OTT derivatives in circulation, here I will show you a screenshot from its website. So it comes around 7,29,000 billion, which is a whoppingly high number. Yeah, so these are the numbers. So if you look into the post from Elon Musk, I have compiled 2-3 posts here. So he's talking about America heading towards bankruptcy. This similar thing, so in the top 5, if you look into Elon Musk, Warren Buffett is also talking about that.
And it isn't the derivative itself. I mean, there's nothing evil about a derivative instrument. As I mentioned, we have 60 some of them at Berkshire, and on Monday I will go over with the directors, I'll go over all 60 some, and believe me, we'll make money out of those particular instruments. The usage of them on an expanding basis, more and more imaginative ways of using them, introduces essentially more and more leverage into the system, and it's an invisible or largely invisible sort of leverage. Now, if you go back to the 1920s, after the crash, the United States government held hearings. They decided that leverage, margin in those days as they call it, leverage contributed to perhaps the crash itself and certainly to the extent of the crash. And it was like pouring gasoline on a fire was when people's holdings got tripped. When stocks went down 10%, people had to sell, another 10% more people had to sell, and so on. Leverage was regarded as dangerous, and the United States government empowered the Federal Reserve to regulate margin requirements, regulate leverage. And that was taken very seriously. And for decades, it was a source of real attention. I mean, if you went to a bank and tried to borrow money on a stock, they made you sign certain papers as to that you weren't in violation of the margin requirements, and they policed it. And it was taken quite seriously when the Fed increased or decreased margin requirements. It was a signal of how they felt about the level of speculation. Well, the introduction of derivatives, index future, all that sort of thing, has just totally made any regulation of margin requirements a joke. They still exist. It's an anachronism. I think Charlie probably agrees with me, that we may not know where exactly the danger begins and at what point it becomes a super danger and so on. We certainly don't know what will end it precisely. We don't know when it will end precisely. Probably, at least I believe, that it will go on and increase to the point where at some point there'll be some very unpleasant things happen in markets because of it. You saw one example of what can happen under forced sales back in October 19th, 1987, when you had so-called portfolio insurance. Well, now, portfolio insurance, and you ought to go back and read the literature for the couple of years preceding that. I mean, this was something that came out of academia, and it was regarded as a great advance in financial theories and everything. It was a joke. It was a bunch of stop-loss orders, which, go back 150 years or something, except that they were done automatically. And in large scale by institutions, and they were merchandised. People paid a lot of money to people to teach them how to put in a stop loss order. And what happened, of course, was that if you have a whole series of stop loss orders by very big institutions, you are pouring gasoline on fire. And when October 19th came along, you had a 22% shrink in the value of American business, caused essentially by a doomsday machine. A dead hand was selling as each level got hit. And 3 weeks earlier, people were proclaiming the beauty of this. Well, that is nothing compared. It was a formal arrangement to have this dynamic hedging or portfolio insurance sell things. But you have the same thing existing when you have fund operators operating with billions and in aggregate trillions of dollars leveraged, who will respond to the same stimulus. They have what we would call a crowded trade, but they don't know it. It's not a formal crowded trade. It's just that they're all ready to sell if a certain given signal or a certain given activity occurs. And when you get that coupled with extreme leverage, which derivatives allow, you will someday get a very, very chaotic situation. I have no idea when. I have no idea what the exogenous factor. I didn't know that shooting some archduke, would start World War I, and I have no idea what will cause this kind of a thing, but it'll happen. If 4 years ago or whenever it was when we started to liquidate Gen Re's portfolio, we had reserves set up for in the hundreds of millions and all sorts of things. And our auditor, and I emphasize any other of the big four auditors, absolutely would have attested to the fact that our stuff was marked to market. I just wish I'd sold the portfolio to the auditors that day. I'd be 400 million better off. It's a real problem. Now, there's one thing that's really quite interesting to me. If I owe you on my dry cleaning bill or something $15, and they're auditing the dry cleaners, they check with me and they find out that I owe you $15 and it's all fine. If they're auditing me, they find out that I owe the dry cleaner $15. There are only 4 big auditing firms, basically in this country, so in many cases, if they're auditing my side of the derivative transaction, what I'm valuing it at, the same firm may often be valuing or attesting to the value of the mark by the person on the other side of the contract. I will guarantee you that if you add up the marks on both sides, they don't equate out to zero. We have 60 some contracts, and I will bet that people are valuing them differently on the other side than we value them themselves, and it won't be to the disadvantage of the trader on the other side. I don't get paid based on how ours are valued, so I've got no reason to want to game the system. But there are people out on the other side that do have reasons to game the system. So if I'm valuing some contract at plus $1 million for Berkshire, that contract on the other side, it's just one piece of paper, should be valued at a minus $1 million by somebody else. But I think you probably have cases, and I'm not talking about our auditors, I'm talking about all 4 of the firms, but they have many cases where they are attesting to values of the exact same piece of paper where the numbers are widely different on both sides.
So he talks about derivatives as a weapon of financial mass destruction. So these are some things that you should be looking into as entrepreneurs, as founders of big hospital groups or big lab chains, etc. I think it's time that you have to look into these numbers. I just made a chart like this, a bubble chart, where the derivatives, the revenue, monthly revenue, the monthly expense, the debt, and all these things are presented together. So this is the bubble chart. My question is the revenue of 400 billion and a deficit of 150 billion sufficient to support an ecosystem of OTT derivatives in the order of 7,29,000 billion? What are these derivatives composed about? It's mostly interest rate swaps, around 470 billion. It is interest rate swaps. If you look into the last 20 years, what has happened? Entire global financial crisis came in 2008. The dot-com bubble burst happened in 2000. Later on, the global financial crisis came in 2008. So what was the fix for that 2008 global financial crisis? The interest rate came down to zero, like you can see in this chart. It stood there at 0% for the next subsequent 5 or 6 years. Up to 2008 onwards to 2014, the interest rate was at 0%, right? So, and if you look into the chart of USD M1 money supply, US dollar M1 money supply, you can see that during the same time, the money supply started expanding. Like the QE1 happened, QE2 and QE3, quantitative easings. So these quantitative easings pumped in a lot of money into the system. So this is how the global financial crisis was resolved. How? By two things. Fundamentally, one, by reducing the interest rate to zero. Second thing, by increasing the money supplies little by little over the next subsequent multiple number of years. So these two things happened. Now see, you can think about a bank, not a bank but most of the banks. The banks, they have to keep pumping money into the system as loans at a lower interest rate, whereas the inflation is going higher because of the M1 money supply going higher. So this is what happened during 2008 to 2016. So what happened in 2015? After a prolonged period of interest rate kept at zero, the stress came to the banking system. Now the banking system cannot keep on lending money at lower interest rate when the system is going towards higher inflation. This cannot happen. You cannot give money at a low interest rate when the inflation is at a higher rate. It's as simple as that. Now the stress came onto the business side. So these are two different sides of economy. If you are supporting the banking system, equity side will face stress. If you are supporting the equity side of this system, the banking will face this stress. By the end of 2018, the Fed has to decide to cut interest rate again to support the equity market from going down. The interest rates, they started reducing, but this did not actually suffice. And on September 17th of 2019, what happened in the one of the largest market, SOFR market, if you look into that. See, like in human beings, we have vitals. Similarly, economy also does have its vital. So SOFR is one of the biggest market, having a volume, if you look into today's volume, it's around $3 trillion. It's somewhere around 27 lakh crore in Indian rupee terms. See, you can say it's the mother of all market. On September 17th of 2019, what happened in SOFR market? So Fed has a note written on that. So I am displaying that note from the Federal Reserve website here. See, this is one of the pulse rate, you can say, of global economy. The SOFR market, the interest rate, the Fed base rate was somewhere around 2.25% on 16th of September, 15th of September and the week preceding that. But on the 17th of September, the rate spiked from 2.25% to 5.5%, and some trades happened even at 10%. So what does that indicate? It indicated stress in the banking system, liquidity crisis in the banking system. So Fed immediately came in. What was the solution? As usual, like giving a steroid injection, the solution was to inject more money into the system, as usual. So this is what they have been doing from 2008 onwards. So in 2020, luckily by the coincidence or whatever, the COVID came into picture, and the solution for COVID was the same as to inject more money into the system. So yeah, so by March 2020, Federal Reserve announced unlimited quantitative easing, and the interest rate further came down to zero again. So but this time they couldn't keep the interest rate at zero for more than 2 years. Earlier period, from 2008, they could keep the rate zero at for around 6 years, but this time the interest rate could be kept only for very short period of time, 2 years only they could keep it at zero. By that time, the stress came back onto the banking system, and they had one of the steepest rate hikes after 2022, from 0% to 5.5%. So after 2020, you can see that the money supply increased exponentially, so that only 20% of the money supply in today's world, in terms of dollar, existed before 2020. So 80%, you can see as in this chart, it was exponentially, the money supply was exponentially increased. What was the result? The money supply, the increase in money supply is not a quick fix, but it has its own side effect. What is the side effect? The inflation. Inflation did come somewhere in 2022. It was at around 9.1%. So to address this inflation, again the interest rate had to be hiked. In one of the steepest hike, the interest rate was hiked from 0 to 5.5%. Hike resulted in the collapse of Silicon Valley Bank, because Silicon Valley Bank has bought the 0% bonds at a very low rate during the COVID crisis somewhere in 2020. Lot of money that rained fresh into the system got parked into these low interest rate bonds. The value of these low interest bonds, which is having longer tenure like 20 years, they went down in the market because now you have two types of bonds. One is the 0% bonds with 20-year maturity, and the other is the 5.5% bonds with the 20-year maturity. So which bond will you buy? You will buy the bond with the 5.5%. So what will happen to the other bond? The value of the 0% bond which was issued in 2020, the value went down. So a lot of bonds Silicon Valley had in their accounts, they were forced to sell that because a lot of people wanted to withdraw money from Silicon Valley Bank and move it to some other bank. That is how Silicon Valley Bank collapsed. So Fed addressed this problem with some programs like BTFP and so on and so forth, and it usually keeps kicking the can forward. As of now, the scenario is like that. The Fed is even politically, Trump is actually requesting Jerome Powell to cut interest rate, but Fed is very reluctant to cut rates. Again, they started cutting rates from 4.25 to further 4%, and the last week another cut came to 3.75%. So if you look into this chart, which is the last historically from the last 100 years, if you look into that, the interest rate has been getting higher and higher from 1950s onward up to 1980. The interest rate peaked around 20% in US in 1980. From 1980 onwards, the rates has been coming down. So 1980 onwards to 2008, the rate came down from 20% to 0%. Now the rate, so what I think is that this cycle is now coming to an end. The long economic cycle is coming to an end, and now the interest rate is starting to increase from this point onward. If you look into the longer term yields, the Fed has been trying to reduce the rates, but the longer term yields are not coming down for the last couple of years. The longer term yield on 10-year bond, 20-year bond, etc. are on the rise. So this is another indicator of stress in the system. If you look into the repo, there was around 2.4 trillion in overnight repo. Now it has reduced to around just $1 billion last couple of weeks back. So if you look everywhere into the system, the stress is very visible. Like if you look in and if you analyze the vitals of the economy, the vitals are becoming very feeble. So you have to look into this, and you have to reposition yourself based on this new available data. We have to define new strategies to survive in the upcoming changes that is likely to happen in global macroeconomic landscape. This may require new strategies like how to move forward in healthcare or in any other sector for that matter, how to move forward by keeping asset-light model, by engaging more number of freelancers into the system, by trying to increase the margins, the operational margins, the profits, by at the same time reducing the capital expenditure, and most importantly, the debt part of the organization. If your organization is having debt, most of the debt in the system as on today is variable interest rate. If the interest rate is headed upwards, like that happened in 1930s to 1980s, then you have to rethink your entire strategy. Like if the margins of your organization will be capable of servicing the debt at what level. So if you analyze the debt of US, around 400 billion monthly revenue, 80 billion they are paying as interest. For on top of 38,000 billion US dollar in total debt. It comes around say 2.5%. Now if the 2.5% increases to say 5%, the 80 billion monthly will become 160 billion. This 160 billion has to be paid out of the 400 billion income. So that becomes a significant percentage. Now suppose that 5% goes to 10%. What is the net result? The entire income of US may not be sufficient to service the interest cost on the entire debt. So we have to figure out where we are standing. Are we headed towards a higher interest rate regime, going forward. Based on this available data, you may have to rethink your strategies, you may have to reposition yourself, and you may have to align for a new world where in every crisis this may head towards a global financial crisis. If the interest rate is moving upwards, the financial systems may be at risk, the derivative systems may be at risk, like Warren Buffett pointed out in 2007, and this crisis may become one of the biggest opportunities of our lifetime if you are positioned carefully and correctly to address these upcoming changes in the macroeconomic landscape.